All right, everyone. This is our last presentation for today. So again, thank you for coming, and we're so excited to have this conference today. So for our last presentation, it is from Aaron Ratner, Executive Director of Alternus and CEO of Clean Earth. Both of these trade on the OTC markets under the symbol ALTNF, as well as the OSE under the symbol ALT. So with that, welcome.
Okay, let's get started. We'll try to be efficient here with everyone's time since we're the last one of the day. Thanks for sticking around. I'm going to tell you a little about Clean Earth and a little bit about Alternus today, and then we'll wrap it up. So a bit about how we got here today. I'm Aaron Ratner. I'm the CEO of Clean Earth Acquisitions Corp. We're a $230 million special purpose acquisition company formed in 2021 to go out and merge with a renewable energy company and help bring it into the capital markets here in the U.S. My background is in sustainable infrastructure investing. I started my career at Generate Capital, one of the initial sustainable infrastructure funds here in the US, founded by Jigar Shah, who currently runs a $400 billion loan book at the Department of Energy. I left there, became a partner and the head of origination at another sustainable infrastructure fund that had been seeded by the late Julian Robertson. After 4 years of that, we looked at about $10 billion of deals, transacted on a few hundred million of them. I left. I became a developer. I worked on a $1 billion carbon capture project with Lafarge Holcim and Oxy, worked on a hydrogen project at the Edmonton airport, and then worked on a series of biogas projects with Tyson Foods and their slaughterhouses. After being a developer for a while, where I really learned about how all this stuff gets built and actually deployed in the infrastructure space, I went and helped form Clean Earth. We are a team of 22 people. Everyone's climate minded. Our chairman, Nicholas Parker, is actually the individual who coined the term clean tech 20 years ago. And so we're all very focused on climate and the energy transition. Alternus Energy, the company with whom we are merging, is a transatlantic commercial industrial utility scale renewable energy business. The company is domiciled in Dublin. It trades currently on the Euronext in Oslo, and we'll be doing a asset purchase where we acquire the assets from the Irish holding company and bring them here onto the Alternus was founded 7 years ago by Vincent Brown, who is the current CEO and chairman. The business started off in Eastern Europe and Poland and Romania doing, as I said, commercial industrial scale solar parks. Today, the company is in Eastern Europe, Western Europe, and the US. Although, as you can see from a recent press release, the business is transitioning a little bit out of Eastern Europe where the returns are a little higher. So, where is the company today? Very strong revenue growth. It's a real business. One of the advantages of building utility scale solar projects is that you build the parks in fields in good geographic locations where you can site them close to interconnection into the grid. So you're not on a rooftop, you're not beholden to a building owner. At the same time, you're not so big that it takes you years to acquire the land, permit it, and then you're playing with the big multi-billion-dollar developers. So we're in a really nice part of the solar space from a strategic perspective. Being in the commercial industrial scale as well is really important for us because while we sell electricity into the grid, the buyers of our power purchase agreements are credit rated corporate counterparties. So these are corporate entities who've made public commitments to reduce their carbon footprint. They're buying clean energy. They're doing that from us off of the grid, which means we can provide a credit rating to our lenders on our offtake contracts. It also means that if for any reason those contracts have issues, there are other buyers that can buy from us off the grid. So right now, with what's happening with residential solar, what's happening with large scale utility solar, we're in a really nice part of the solar space. So great revenue growth over the last few years. As everyone knows, the solar space is growing exponentially. The International Energy Agency every 2 years puts out an estimate of solar growth, and every 2 years they underestimate it. You can see those curves over the last 20 years. So that we think will continue. We've got a great pipeline of projects. At the moment, we have 168 megawatts under operation. We are selling out of Poland. We made a public announcement about that. Eastern European was a great place to launch the company, but at the moment, we see much higher return on equity and return on executive time in Western Europe and the US market. So we've got a great pipeline. Excuse me. We have great, obviously, tailwinds. The Inflation Reduction Act here in the US is providing a lot of incentives for investors to come into the space, whether that's corporations, tax equity investors, banks. And then in Europe, there are similar programs that are coming into play that are really incentivizing people to develop in the space. We've got good EBITDA growth over the last few years. Companies have been growing very well. Solar companies in our space have positive EBITDA growth. They have negative net income, but the EBITDA is great and growing. This year, we think we'll do about $15 to $16 million of EBITDA. Next year, we anticipate that multiplying. The transatlantic operations for us are also quite strategic. There are ways in which we learn best practices from developing in Western Europe and the US that are synergistic to us. And we have great development teams in Spain, Italy. We will look at projects in Greece as well. And obviously, we're doing some things in Ireland where we're home based. And the vertically integrated part of our business, I think, is another key attribute. So we have a development arm where we pick up projects. We start at a field. We build them, develop them all the way from designing and permitting them all the way through to construction and long-term ownership and operations. And what that means is we can control our pipeline. We have a lot of control over the pipeline. So we're able to forecast when these projects are going to go into construction and when they're going to be kicking off electrons with a lot of clarity. And that's important for our investors and our lenders. It also means that we don't end up in bidding wars for projects when they hit what's called ready to build. So, typically in the solar space, there's a lot of developers who will sell a project the second it's ready to break ground. Because we're a long-term owner operator, we don't end up in those bidding wars. And actually what's happening here, particularly in the US and Western Europe, there are a lot of situations where the seller of land or the entity that's looking for a solar developer to come in would much prefer it's the same entity for the next 20 years versus someone who's going to come in and opportunistically sell that project to somebody else 12 months later. So the continuity of relationship with the landowner, particularly when you're buying from municipalities or wealthy families and landlords, is really, really valuable. And then, of course, we have a really proven commitment to ESG, which I can talk about later. So how big is the solar market? Everybody knows it's enormous and growing rapidly. It's still a very small fraction of the global energy supply. But, we all know that we can power our planet with solar energy once we build the panels out and we build the infrastructure. In both the US and Europe, the forecasts are tremendous. These are trillion-dollar markets over time. Technology continues to improve on efficiency, which is the ability of a solar panel to capture sunlight and turn that into electrons on the grid. So the technology is getting better and better over time. We are totally technology agnostic. We work with equipment providers across the globe. We try to, obviously lower our CapEx costs, and we have great relationships with our suppliers. The equipment side of this business is effectively going to be an arms race to the lowest common denominator. So we try to stay away from owning any equipment providers or having any biases there. So the costs of CapEx are going way down. Even there's a lot of onshoring of production in the US that will happen in Europe as well. So there'll be more control over supply chain. And then, of course, on the other side of that trade, there's a lot of incentives for investors to be investing in these projects, whether it's tax equity or just senior bank debt. We can go into the Inflation Reduction Act a little bit here in the US. It's really a generational market opportunity. The Department of Energy has done a great job deploying capital. The tax credit regimes are in place and should be in place for 10 to 20 years, which provide a lot of clarity to developers and investors on the benefits investing in these projects. We think this will only continue, particularly as job growth starts to evidence itself around the country, where you have people in rural areas picking up long-term stable jobs from being involved in renewable energy. Similarly, in Europe, the programs over there are equally effective. There's a lot of job creation, and there's a lot of projects going into the ground, particularly in countries that have great solar footprint, like Greece, Italy, and Spain. So a little bit on the business model of Alternus. As I mentioned, it's a fully integrated vertically business model, and that provides a lot of advantages to us. So it reduces our CapEx costs over time because we control the construction. We're able to order equipment at scale, which gives us economies of scale on pricing and delivery. The business grows from a very early stage, so we have a lot of continuity on our pipeline, and we're able to be very clear with our investors and our lenders about the way and the schedule of deploying capital. So an example of that is last year, we secured a 500 million euro credit facility with Deutsche Bank for projects in Europe in construction or operations. The markets have been very choppy. We have yet to deploy that. We will begin to deploy that after we conclude our merger next week. We've got great access to construction and operating debt. And because we're bringing these projects up alone, on our own, we also control the scheduling, which is actually quite difficult. So what is the long-term business model? The business model really is how you recycle your equity. So you get in early and you deploy equity to start developing the projects. Those projects begin to become more valuable as you advance through the development cycle. And eventually you get to what's called ready to build, RTB, break ground, build the project. The size of the projects that we work on generally can complete construction in less than 12 months, which is really advantageous for refinancing between construction finance and long-term debt. These projects start to kick off electrons when they actually reach operations. In a lot of geographies, you can refinance that construction debt and actually take off over 100% of the equity that you put in, because the loan to value at that point is higher than the equity that you invested. And so you start to create a bit of a flywheel there where you're recycling your equity at very high net present value. Alternus has a proven track record of delivering. It's a great execution team. As I said, they're based in Dublin, but they have people here in the US, in Western Europe. The Eastern European projects also perform very well. They've been growing over the last few years, and we expect them to continue to grow into the future, particularly once we're NASDAQ listed and have better access to capital markets. This is our future growth plan. What it shows is what's operating today, what we're targeting to acquire. We have one of the things, as many of you will know about trying to go public, is you have to sit still and not close any deals, because if you move your balance sheet around or the value of your company around, you have to go through another cycle with your auditors, accountants, and the SEC. We actually thought we would be done with our process in the second quarter of this year. So we had a 6-month delay there, but we're finishing next week. We're through all the approvals, just waiting for the NASDAQ to sign up. But this is our pipeline. We'll be announcing a lot of projects next year. We'll be acquiring some operating projects. We'll be announcing a lot of development projects that we're getting involved into, both, as I said, in the US and Europe. And where we think we get to over time is about 3 gigawatts in 5 years. And at 3 gigawatts, then the business gets on what we call a perpetual flywheel. And at that point, is very, very equity efficient. Company's got great ESG credentials. Everybody's seen these metrics. This is the spirit of the business. Everybody who works at the company cares a lot about the environment. The projects that we work on are meaningful to the grids that we're plugging into, and people make this at Alternus, it's their life mission. So the work really matters to folks, and that's been obviously really helpful to us in what's been a challenging market. We've got a great experienced leadership team. Vincent is the chairman and CEO. Bought the company, bought a few projects from some developers very early on. Our CFO has got tremendous experience in this space and has done billions of dollars of transactions. Chief legal officer's also got a lot of strength in the sector. So we've got a lot of people who come at this with a lot of experience and have been working together for a long time, which is really important. So, what are the numbers looking like? We're growing really well. The business is growing on all metrics. EBITDA is growing, revenue is growing, megawatts are growing. We expect this to continue. We think getting listed here in the US and hopefully turning a corner in 2024 and the world taking a deep breath could provide a lot of upwind for us here in the US and also Western Europe. The objective, 3 megawatts by 2026, that's our target. We are going to do that through acquiring development rights, acquiring projects in development, and acquiring potentially some operating assets. These will be, as I said, utility scale solar and storage projects. We may look at some microgrids and others, but we're really staying in our lane. We think that there's enough to do that we have expertise and that we don't have to stray into other technologies. And certainly we'll never take any technology risk. What we're trafficking in right now is proven technologies, proven systems that the grid operators will be very comfortable with when we start plugging them in. This is one of the most important parts of the business. It's a very equity efficient model, as you all can imagine. The banks are loaning to solar storage projects. There's tax credits, as mentioned, particularly with a lot of the wind in the US coming offline or wind projects backing up. There's an abundance of tax equity available. That's really advantageous to us. Our business model at the moment requires us to raise about $65 million over the next 12 to 18 months of non-senior debt in order to hit a point where we never have to raise equity again unless we do it for growth. So our number is $65 million, 12 to 18 months. We'll do that through a variety of capital facilities that we put in place post going onto the NASDAQ, as well as next year as the stock settles and the world turns around and everybody, a little bit of friction comes out of the market, hopefully. That number gets us to about 750 megawatts developed and deployed annually, which puts us on trajectory to be a very successful multi-billion-dollar market cap business over time. This is our, what the business looks like. As I said, EBITDA positive growth. There's, shows a net income loss, but this is standard for the industry, and we will eventually get to a point where we're very cash flow positive. That's sort of the presentation I have for today. Just to review, we're in a really great part of the solar space. The utility scale C&I space is great from an execution perspective and a counterparty perspective. We've got a great team of people who've been working together for a long time. They know each other well. They've been through a lot. They're going to be very successful when we get on the NASDAQ. We're a proven business model. The equity efficiency has already been evidenced. We've sold a project that we didn't put any equity in at one point. So we know we can do it, got positive EBITDA growth, and of course, being listed in the US and focusing our efforts on the US and Western Europe is going to improve the return on equity and improve the return on executive time as well. That, I will conclude the presentation. Be happy to answer any questions.
Thanks. So when you look at projects, usually there's some advantage, right, that a developer has, whether it's smaller, inefficient projects that the big guys aren't getting up from behind their desks to look at. What would you say is your focus that gives you an advantage to identify this, and what larger scale being highly commoditized, cost of capital? What's your niche in this, if you want to call it that?
I think our strengths there's a few of them. One of them, the team that we have has a lot of experience closing deals. So we're very efficient at getting to yes or no quickly. And in this business, you can build a reputation for saying no because it's not going to be a good fit and letting someone go somewhere else. And that's really valuable because a lot of developers who are living on hand and fist and having trying to be entrepreneurs in the space, they need investors to close the deal. And if investors are treating it like an option and not actually closing or dragging their feet, it's a real problem for developers. So when you have a reputation for either being very clear with the development community, when you know what you're going to do and what you can't do, people will seek you out and give you a look at the project. We also have very local teams. So we have a team in Spain, a team in Italy, got a team in South Carolina, a team spread around the US that we're building out. And you also need local people, right? If you want to plug into the grid, you need to know the grid operator. You need to know the guy who services the base station, right? The substation. You have to actually know the people involved because all of this, and this goes for the entire energy transition, it's a physical infrastructure revolution going on here. It's not software. It's not, you just don't put it up on the internet and hope it works and you take it down if it doesn't. I mean, you go to build this stuff, it has to work right. So there's a lot of people who work in this space whose day jobs depend on these technologies working. And when they don't, those people suffer. And so it goes back to my point about really staying focused on technologies that work. So we have very locally deployed talent. We have people who know what they're doing. My experience in project finance, our CFO's experience in project finance, we really understand how to put these things together in a very equity-like model. And then I would say also, in the more of the soft science, it turns out that developers with an Irish accent are very competitive in the market. For some reason, they just run around the US and win a lot of projects. We've had great success in Texas and the South, certainly more than I ever with the accent that I have coming from the Northeast.
Aaron, some questions came in from the online audience. The first one was if you can speak to the timing of getting up and trading on NASDAQ.
Sure. So the Clean Earth acquisitions, that is trading today. It's CLIN is the ticker. We are through SEC approval. We are submitting our final NASDAQ forms. We expect to close next week, have the ticker change towards the end of the week. So we're a week away from executing on
that. There's a couple questions that came in asking for you to elaborate on some company statements.
Sure.
So one of those is asking about how do you see the impact of the Inflation Reduction Act, and how fast do you see that impacting your financials and prospects?
Well, I think the broad effects of the Inflation Reduction Act are already occurring in the American economy, right? It's creating jobs. It's incentivizing utilities to do more in the renewable energy space. The banks are lending. Obviously, interest rates have gone up. That's been painful. We would not be making such a big push into the U.S. if we didn't have deep conviction in the enduring strength of the Inflation Reduction Act and the programs that the Department of Energy are putting to use. That facility we have in Europe, the facility with Deutsche Bank, 500 million euros. We're going to try to replicate something similar here in the U.S. with an infrastructure bank, put that in place, and we continue to think that over time, by about 2025, a majority of our EBITDA will come from U.S. projects.
And can you comment, I guess, on your ability to earn much greater returns for the same amount of equity deployed in the future?
Well, greater returns than what? Than our business in previous years, or
Yeah, I think
or-
in previous
yeah.
years. It's about looking forward.
Sure.
And
Yeah, so I think our EBITDA margin will improve over time as we scale up the projects that we're doing. You know, you get economies of scale from ordering equipment. You get economies of scale from doing repeat projects with the same utility, for example. So just as efficiencies increase and we get a little bit bigger, I think we'll have a bit of margin improvement over time.
are there any other questions for Aaron? Right. Thank you, Aaron.
Thanks very much for having me.